Blue Owl reported results this week after joining forces with Meta on AI data centers. The firm reported a 21% year-over-year jump in AUM as it continues to reinforce its long-term growth pipeline. Joining us for more is Marc Lipschultz, Blue Owl Capital co-CEO. Marc, wonderful to have you on this morning. And I know whenever anyone asks about the equity price, you very astutely are like, we don't concentrate on the short term. But there was a decline after earnings, so we have to address it. You had record fundraising, maybe a concentration on some of the flat fees. Why the disconnect between the two?
Yeah, look, we had a great quarter. We had continued extraordinary growth, 20+% growth on the top line. I think there is, as you just noted, this disconnect, which is having acquired very successfully and very fortunately businesses like our digital infrastructure business IPI. You issue shares, but then you don't have a full year of their results. So it's actually just math. As you look at our run rate growth per share, it is continuing to accelerate, and it continues to be incredibly robust. So yeah, there's a little bit of math, but it really is just simple math. Business is really thriving.
I learned so much from watching Danny's interviews with people like you. So she had...
to be clear, you're learning more from Marc than you are from me.
Yes,
I'm just happy to be there.
And from Z, and from Henry McVeigh, and from John Gray. You were talking with him, Danny, and he was saying something about easing excess returns in private capital. And there's a market saturation. We see very tight spreads, and generally lower yields are headed lower. What do you think about that? What do you think about that idea?
So I would decompose the question of kind of yields, returns into three components, right? One, of course, is credit quality first and foremost. Like at the end of the day, the most important thing is that you're making good loans and getting paid back.
No cockroaches.
And so we want a very healthy ecosystem, and we have a very healthy ecosystem. We really do, and we can certainly come back to that. So credit quality is excellent in our book, and that doesn't mean no defaults. Everyone's going to have defaults now and then. We said multi-trillion-dollar industry. That's okay. You just can't have many, and you have to get good recoveries, and that's exactly what we do at Blue Owl. And by the way, so do our peers, and so do the banks. So the system is in a strong place. Then, of course, there's base rates, and of course, the direction of base rate travel. Everyone obviously sees it having eased from the peak, but again, every time consensus spills to, oh, it's obvious, you look at the Fed commentary. Now it's not quite so obvious how fast rates are going to go down. And then last is spread. And spreads are on the kind of, I'd say, the lower side of where we operate, but over a 10-year window, they ebb and they flow. And remember, we're building portfolios that have hundreds of names in them. Some are from a couple years ago, some are current. And most importantly, our overall spread, the premium that we offer to the alternative, the traditional marketplace, has actually been stunningly steady and close to a couple hundred basis points. So yeah, we don't live in a vacuum, and so spreads in the whole world are tight. Of course, ours are tighter. Equity markets are at all-time highs. Like we don't live in isolation, and in that world, spreads are a little bit tighter. But in total, we continue to deliver really outstanding investor results, and that's why we had record fundraising results.
I have to say, I really like that point you made about, okay, if we're concerned about private credit, shouldn't we be concerned about equity markets too? They both are trading and reflect a large part of this economy. I would then love to get your take on Meta yesterday. I know you're not a public stock guy, but when they issued more debt, Meta shares fell. Do you think that there are starting to creep into the market some concern with Meta, of course, as one of your partner, but the large hyperscale spending and the amount of financing and debt that they're taking on? Is there any reason to be concerned? Because clearly the equity market is starting to show at least a little bit of nerves about it.
Well, there's been several earnings reports this week from tech companies, and actually some of them performed extraordinarily well, announcing big capital programs, right? Amazon. And so I think it's hard to attribute it to one specific action. In fact, the collective result is, of course, tech is touching all-time highs at the moment where, as of this week, people announced, you know what, we're actually going to spend a lot more on AI infrastructure than we thought. Much more, actually, right? This continuing curve, every time you look, it just keeps going up, and you listen to the commentary, and the commentary is, we don't think we're spending enough. Microsoft says we don't have actually enough capacity to even fuel both AI and kind of our core business. So that gap, very expensive to cross that Rubicon, of course, is what creates the opportunity for great partnerships, for us to bring that kind of capital in conjunction with these spectacular companies to build the backbone, which for us is the very safe way to participate, build the backbone for this infrastructure, for the infrastructure for this AI future.
I was talking with Z about the intel he gathers, and you obviously are in the same sort of privileged position, right? You're talking to so many portfolio companies and CEOs, and you have an incredible view of, for example, the labor market. So what are you seeing in your portfolio companies, or what are you hearing people say about the economy in regards to the labor market? Are they going to be slowing hiring or even reducing jobs as they replace some of that productivity with AI?
So portfolio companies are, let's start with, very strong and healthy. We have 400 or so in our portfolio, and on average growth remains, both revenue and earnings, in the high single digits. So it's a very healthy place. No,
but
we're not
strong companies can reduce headcount as well. Right?
Absolutely.
Yeah.
So no, we have not seen any meaningful change in labor practices, but it is certainly the case that technology itself is making a lot of activity already more productive, and we're at the very front edge. So, it is certainly the case that when you build and invest this kind of capital, you do ultimately have to get a return on it, and some of that will disrupt the traditional labor market. But we are not hearing anything I would call systemic or dramatic at this point within the portfolio. And to the degree it's happening, it's really more about efficiency, technology. It's not about concern about the economy today.
Blue Owl has also been on the forefront in moving into retail and offering wealth products to a wider swath of investors than traditionally had been. I just wonder, Mark, because this has been a period where it feels like people are laser focused with the magnifying glass, if I can mix all my metaphors, on private credit, with Jamie Dimon saying cockroach here, concern about fraud there. Has it changed at all retail sentiment? Has it been harder to reach those people just in the volatility of headlines that have been coming out?
So here's the really encouraging part about the wisdom of what you call retail investors, individuals taken together. I think there's a propensity to want to either sort of, people say, oh, they don't understand. I actually think there's incredible wisdom in the individual investor world. And by the way, they're advised by really strong people, right? The financial advisors at the Merrills and the Morgan Stanleys and the JP Morgans, the Goldman Sachs, I mean, all these, Wells Fargo, all these fabulous places are advising people on making these choices. So here's what we're seeing. Wealth flows are accelerating even now, this month over last. We see this every day. It's a very data-driven business for us. We are accelerating in wealth this month over last. So actually, I think people are seeing through this noise, and it is a lot of noise. And to your point about sort of an item here, an item there, I would suggest when we take a step back, because there's almost this kind of this mass hysteria taking hold about credit in general, private credit in particular, and it's just not anchored in any facts. It's anchored by repeating a few anecdotes and then kind of just creating well, hey, you never know. And some of that is intentional. Some of it, I'm sure, is quite sincere by people that just aren't sure. But the truth is that our system, the private credit, not just Blue Owl, our peers are very good at what they do. The banks are very good at what they do. And in total, fortunately for the economy, we have a very healthy credit ecosystem. And to the earlier point, Danny, you repeated, which I think is really important to remember. You cannot believe that we have an unhealthy credit ecosystem and a healthy stock market. Those are not compatible ideas.
Well, and I mean, as you point out, the concerns are belied by the fact that investors are still falling all over themselves to get access to funds like yours. Mark, great having you on the program. Thank you so much for joining us. Marc Lipschultz there of Blue Owl Capital.